A massive 20-year research study on the ultra-wealthy uncovered a terrifying paradox, one that completely shatters how we view money. The data proved that nearly 70% of high-earning professionals live paycheck to paycheck, carrying a net worth of absolute zero due to hyperinflated consumer liabilities. Meanwhile, low-profile trade workers like welders and auction clerks routinely accumulate quiet multi-million-dollar fortunes using a hidden cash flow loophole. Hi, I'm Ray, and today we're decoding the wealth accumulation formulas that turn raw income into absolute financial independence. To see this financial illusion in action, look at Vivek, who chained his income to a rapidly depreciating sports bike, versus Karan, who leveraged debt to double his salary. Let's expose the precise mechanics behind this invisible wealth shredder, crush the primary residence house myth, and deploy the ultimate agnostic financial multiplier. If you break your arm, the doctor doesn't guess what's wrong. They look at an X-ray, point to the crack and say, "Yep, that's broken. It's beautiful, really, black and white." They slap a cast on it and you're good to go. But step into the world of personal finance. Suddenly, we're all just trying to read tea leaves. You could show the exact same bank statement to two financial experts. One will tell you to pack your bags and move to the mountains, while the other says you're basically a future millionaire. Because debt isn't just a giant scary monster, it's more like fire. You can use it to cook a great meal or, well, you can burn your toast. Let me show you what I mean. Let's look at two guys. We'll call them Vivek and Karan. Let's start with Vivek. Vivek loves a good lifestyle, and honestly, who can blame him? He wants the aesthetic cafes, the weekend getaways, the whole living my best life package. But to fund all this fun, Vivek took out a high-interest personal loan for a Euro trip and an auto loan for a very loud, very shiny sports bike. Because why not? The catch? He is sending 28,000 rupees every single month straight to the bank in EMIs. EMI, equated monthly installment, or as I like to call it, early morning insomnia. Basically, a big chunk of his hard-earned salary evaporates before he can even think about buying a pizza. Now let's look at our second guy, Karan. Karan also has a thing for loans. He also sees money vanish from his account every month. 22,000 rupees to be precise. But Karan didn't buy a trip. He did what fancy finance folks call a human capital play. Let me decode that. He invested in his own brain. He realized that at age 22, the best thing he could level up was himself. So he took an education loan for an advanced data science certification. Now, if a computer at the bank just looked at their accounts, Karan and Vivek look like twins. They are both bleeding cash. Vivek loses 28,000. Karan loses 22,000. It looks like they're both just drowning in debt, right? But wait for it. Here comes the plot twist. Karan's fancy new skills landed him a massive 120% salary hike. He went from checking his balance before buying a coffee to earning about 3 lakhs a month. Suddenly, that 22,000 rupees EMI doesn't feel so heavy anymore. It's barely a scratch. He pays rent, lives a great life, pays his loan, and still has a 40,000 rupees monthly surplus. Pure cash left over every month. Isn't that the dream? Now I know some of you are thinking, but Ray, isn't Karan's move risky? What if the job market crashes and no one hires him? He's still stuck with that 22,000 loan on a junior salary. And you're right, he could definitely struggle. There are no guarantees in life. But here's the magic concept that helps make these choices. Expected value. It's basically asking, if I took this exact same risk 100 times, what's the average result? Let's look at Vivek. His expected value is mathematically guaranteed to go down. That holiday is a memory the second he lands. The bike loses value the second he starts the engine. He's paying extra interest for things that are actively losing their value. It's a tough spot to be in. But Karan? Sure, a bad job market is a risk. Maybe there's a 30% chance it takes him a year or two to find that dream job. But there's a 70% chance he sets himself up for a lifetime of higher income. Think of it this way. Vivek's loan is like paying a monthly subscription for a streaming app. But you've already binge-watched the only good show they had. Karan's loan? It's like buying the VIP pass to the best theme park in the world. Vivek used loans to buy a fun weekend. Karan used loans to upgrade his future. It's a completely different game. So how do we actually know if we're buying a real upgrade or just a really expensive illusion? There's a very famous finance book called Rich Dad, Poor Dad. The main rule in there is wonderfully simple. It's like finance for kindergartners. An asset puts money into your pocket. A liability takes money out of your pocket. Now, your accountant might say your car is an asset. Legally? Sure. But practically? It's a bit of a cute, shiny money pit. Which brings us to the absolute spiciest topic at any Indian dinner table. The dream house. Buying a massive house to live in? It's beautiful, but it's an emotional liability. Every single month it asks for EMIs, property tax, and money to fix that leaky roof. It only takes money out of your pocket. You can't exactly pay your grocery bill with the emotional value of your beautiful living room wall. But what if you buy that exact same house and rent it out? Boom! The tenant pays the EMI and it puts money into your pocket. Now it's an asset. Now let's check back on Vivek and his super shiny sports bike. A vehicle is basically a metal box that loses value the second you happily drive it home. By year 5, it's worth half as much. It's like a very fast, very expensive melting ice cream cone. Even his insurance company tells him it's worth less every single year. Ouch. So Vivek used an expensive loan to buy something that actively loses its value. And while his bike shrinks in value, so does his cash, thanks to our old friend, inflation. Inflation is just a sneaky, invisible monster that slowly eats the buying power of your money. It basically means 100 rupees today will buy you a lot less chai 5 years from now. So how do we actually survive all this without stressing out? Enter the trusty 70-20-10 rule. It's simple and it works like a charm. 70% of your income for living, 20% for investing, 10% for fun or paying off debt. Vivek completely ignored this. Karan followed it. Let's fast forward 3 years. The difference between our two guys is like night and day. Vivek is super stressed. He missed one EMI because he had to get a surprise root canal. Now his credit score is literally crying in a corner. If he wants a new loan, the banks are going to charge him a massive amount of interest. Meanwhile, Karan is basically playing finance on easy mode. Remember that 40,000 rupees extra he had left over every month? He didn't buy a fancy watch. He invested it. He built a solid portfolio. So he literally makes money while he sleeps. Then he used those investments to get a super low interest loan. And he used that to buy a sweet little rental property near an IT park. It might sound a bit boring, but his tenant completely covers the mortgage. The property value went up and someone else is paying for it. It's basically like getting a stranger to buy you a house. Pretty neat, right? Vivek is working super hard just to pay off his past fun. But Karan's past is working hard to pay for his future freedom. That's the true power of leverage. Borrowing money is a superpower if you use it to buy things that actually grow in value. In fact, inflation actually helps Karan. He gets to pay back his old loans with tomorrow's cheaper money. But using loans just to buy fancy things for Instagram, it's like walking in financial quicksand. So next time you swipe that card, ask yourself, am I buying an asset or just an expensive illusion? Remember, you want to build your future, not just borrow it. Drop a comment below. Based on the data, do you see yourself as a UAW or a PAW right now? If this breakdown shifted your perspective, leave a like and subscribe to keep decoding the system with us. For daily visual breakdowns, follow Z-Ring across all platforms. I'm Ray. See you in the comments.